I think we're going to see a strong year for gold and by extension silver. Obviously, gold at $2,000 an ounce, now above 2,060 or 70 almost. That's pricey, and it's at or near record highs in absolutely every major fiat currency. That's pretty dramatic. So I think that's going to continue to attract more attention. And then when people look at that and they see, an ounce of gold is $2,000, it's going to look pricey for many. And they're going to look for an alternative. And silver is that natural alternative. The safe haven status and the money status of silver will temper the risk of softness from industrial demand.
Starting the year at $1,824 per ounce, gold trades around $2,065, denoting a 14% rise and potentially marking its first annual increase in 3 years. Notably, the historical high for gold prices reached $2,135.39 per ounce in early December 2023. However, the momentum slows as gold prices retreat after hitting a 3-week high, impacted by a strengthening US dollar and rising Treasury yields, which counter expectations of Federal Reserve rate cuts in the upcoming year. Geopolitical tensions and decreasing inflation rates play pivotal roles in driving the price of gold up by more than 10%, marking its most impressive performance in 3 years. Despite several challenges, such as persistently high interest rates, a hawkish Federal Reserve stance, a robust dollar, and attractive high-yielding bonds, gold exhibits resilience throughout the year. Peter Krauth, editor of the Silver Stock Investor newsletter, recognizes these hurdles, especially in contrast to the stock market's strong performance. Despite these obstacles, gold maintains its strength, displaying remarkable stability. Data from the World Gold Council, WGC, reveals that major central banks rapidly accumulated gold at the beginning of 2023, providing substantial support and keeping gold prices around the $2,000 mark, indicating a bullish trend. Silver, in contrast, demonstrates a relatively stable year, closing nearly flat. Its market behavior reflects a unique situation, unable to reach a 3-week high or surpass previous peaks despite expectations of US interest rate cuts and a weakening dollar. Peter emphasizes silver's role as a natural alternative to gold during price surges, citing its status as a haven and monetary asset that could offset any potential decline due to reduced industrial demand. He highlights silver's irreplaceable nature in various industries, suggesting that its widespread and critical applications could counteract any slowdown resulting from economic weaknesses or a recession, ensuring a sustained demand across multiple sectors. We will present clips from Peter Krauth's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
Gold in particular has been so impressive because if you think about some of the headwinds that gold has faced this year, we've had rates really high, have been sustained high. The Fed, until at least the last meeting, has been talking quite hawkish, and that it's going to be higher for longer, all that sort of thing. So with that, you've had, until again recently, a relatively strong dollar. You've had bonds with providing some pretty high yields. At one point, I think it was in November, early November, we had nearly entire Treasury market. All the maturities were above at or above 5%, which was huge. And so these are big headwinds, and stocks started to do well. So the broader market. So these are all pretty strong headwinds for gold and silver. Gold, as I say, really held up particularly strongly, and that was quite surprising and quite welcome. And I think that one of the big reasons, if you think about having all these headwinds and staying that strong, you kind of have to ask yourself what's driving that. And so I think the answer mainly to that has been central bank buying. I think last year it was a record year and by far outpaced any previous year. So we were at about 1,080 or 1,083 tons of gold bought by central banks. And this year we're on pace to nearly match that, somewhere around 1,000 tons again for 2023. So that's been massive buying by central banks. So I think that the physical market has been very much supported by that kind of buying, and I think that's what has kept gold so close for so long to somewhere around the $2,000 level, and now we're comfortably above it. Again, very bullish. I think we're going to see a strong year for gold, and by extension, silver, for similar and as well as for some different reasons. I do see the risk of softening industrial demand having an effect on the price. And I would not discount, that risk or that risk factor. Certainly it's there. But I would say that there are some reasonable odds that that gets tempered by, as you say, one of the ways that that would be tempered is through demand for safe haven in silver. Obviously, gold at $2,000 an ounce and now above 2,060 or 70 almost. That's pricey, and it's at or near record highs in absolutely every major fiat currency. So that's pretty dramatic, and that's certainly one way that we've seen historically that defines a bull market for gold. So silver tags along. People will become a lot more, I think, this year aware of what's going on in the gold market. It's quite surprising, actually, that it hasn't attracted more attention, especially with, I mean, it has started to, certainly with now being above 2000 and at or near record highs for extended periods. So I think that's going to continue to attract more attention. And then when people look at that and they see, an ounce of gold is $2,000, it's going to look pricey for many, and they're going to look for an alternative, and silver is that natural alternative. So I think that the safe haven status and the money status of silver will temper the risk of softness from industrial demand. And there's another aspect, I think, of industrial demand that we have to account for, and that is, especially if you look at the industrial uses of silver, and so many of them are energy transition related. Solar panels. It's in wind energy. It's in EVs. It's in EV chargers. It's in 5G telecom. It's used in upgrading power grids. It's really ubiquitous and irreplaceable, in fact, in so many of its applications. So you could say, all right, so that's fine. All of these things are going to slow down if we have an economic, if we have a recession or if we have economic weakness.
The deficit in silver has come down from 253 million ounces to about 140 million ounces. This will support prices on the way down, and since next year seems to be bullish for precious metals, silver will also go up along with gold. Peter emphasizes a consistent deficit in the silver market over the past 3 years, encompassing the present year and the preceding ones. Last year particularly stood out with a significant deficit surpassing 250 million ounces, despite the average annual silver market hovering around 1 billion ounces. Mining contributes roughly 80% of silver production, while recycling makes up about 15 to 20%, up to approximately 1 billion ounces per year from these primary sources. However, per the Silver Institute's estimations, the demand for silver exceeded the supply generated from these primary avenues. To address potential queries about the existence and continuation of deficits in this context, Peter acknowledges the presence of secondary supplies and inventories in the market, which are difficult to quantify accurately. These secondary sources, including existing inventories held in coins, bars, and jewelry, contribute to balancing the shortfall. When the price of silver rises, some of these reserves are brought back into the market as people seek to sell, but there's less inclination to do so at lower prices. Let's get back to the interview.
The deficits have existed for the last 3 years, if you include this year, and last year's was a massive deficit of 200, I think, in just over 250 million ounces. And silver is a billion ounce a year market. So about 80% of that comes from mining, and then the others variably 15 to 20% will come from recycling. So between the two, you have about 1 billion ounces available from those two sources every year. Now, when the Silver Institute calculates its deficit, they say demand has surpassed those two sources. Now, your viewers are going to say, well, how can you have a deficit, and certainly how can you have an ongoing deficit? Well, there are other supplies, there are secondary supplies, there are inventories that exist in the market, and unfortunately, even for professional research services, they're hard to gauge and to know exactly how much. So nobody really knows quite how much silver out there that there might still be. But there's certainly plenty of silver that people have accumulated in the form of coins and bars. You have silverware, you have jewelry. The higher the silver price goes, the more some of that comes out and comes back to market because people will, for whatever reason, want to cash in. But with the silver price relatively low, none of that really comes that much to market because people don't feel they're getting enough to sell their scrap or whatever it might be. So, but that is mostly how that shortfall is made up. So from existing inventories, other than, either scrap, recycling or mine supply. Now, we know that there is silver, that is an inventory that exists in some of the silver ETFs. So some of the holders of the ETFs, not all, can, if they own enough units in that ETF, can stand for delivery. So they can ask for physical delivery of if they own enough units in that ETF. And then you have the futures market. I'm no expert in that, but I will say that to my understanding, if you own silver futures, you can request delivery in kind at the expiry date of your contract. If you look at, and I do look at this regularly, but it does seem as though in the past sort of couple of years, the inventories in the futures markets, the COMEX, and the London Metals Exchange, that these inventories have been coming down very regularly. So it seems as though you have holders of futures that are taking delivery gradually more and more. So all of the indications are that whatever the inventories are that are out there are gradually shrinking. So we can't know exactly when. If I had to guess, I'd say, we could be at somewhere maybe around another couple of years at most, where it kind of dries up. And so you don't have the secondary supply to draw on anymore, and the deficits really start to hit home.
Analysts anticipate a 10-15% rise in silver prices in 2024, but it might underperform compared to gold. The gold-silver ratio is expected to increase due to a projected 20% rise in gold prices during the same period. What is your outlook for the future prices of gold and silver? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.